Welcome, everyone, and thank you for joining our Trailblazers webinar today. My name is Cheryl O'Connor. I'm CEO and co-founder of Income Conductor, an award-winning retirement income planning technology that engages your clients in the planning process and provides them with a strategy that gives them income reliability, not probability. Joining me is my co-host, Mark Butler, a consultant to wealth management and wealth tech firms and founder of Wealth Management GPT. Good morning, Mark.
Good morning, Cheryl. How you doing today?
Good, good. Looking forward to the holidays.
Absolutely. Excited for our guest today as well.
Yeah, exactly. So for those of you who are joining us for the first time, our Trailblazer series highlights the people in our industry who are forging new paths and developing new ways to achieve success while providing great outcomes for clients. We welcome your questions, so please type them into the Q&A box, and we will address them during and at the end of the webinar. So it's my great pleasure today to welcome our Trailblazer, Larry Roth. Larry currently serves as managing partner of RLR Strategic Partners, a strategic consultancy, private investment, and M&A advisory firm focused on the wealth management space. Larry also serves as a senior advisor at Berkshire Global Advisors, a leading investment bank focused on the financial services industry. Previously, Larry held the position of CEO at both Advisor Group, now Osaic, and Cetera Financial Group, two of the largest independent wealth management firms. A CPA and an attorney, Larry has structured dozens of value-creating transactions as an investment banker and has successfully acquired, grown, and sold financial services businesses as an entrepreneur and private investor. He also advises senior management teams and boards of directors across the industry, delivering high-impact strategic growth plans and execution support. Welcome, Larry.
Thank you, Cheryl. Thank you very much. I appreciate being here. Nice to see you. Nice to see you, Mark, also.
Well, it's great to have you here. So could you share with our listeners how you started in the industry and also your perspective on the evolution of the independent wealth management space over the past couple of decades?
I'd be happy to. And so I started you mentioned I'm a CPA. I started my career at Deloitte in one of their practice offices. And we had a number of clients in the wealth management space, more on the investment side, asset managers and real estate companies, et cetera. So I was exposed to the independent wealth space as an accountant, frankly, back at that time. But after leaving Deloitte, I was able to buy a small firm, which interestingly to me at this stage of my career was a little bit ahead of its time. It was a registered investment advisor, fee-based, but also owned a broker-dealer. It was based in Ohio. And so my family and I moved there, and I worked for, but goodness, that was for about 8 years or 9 years, growing that into a pretty sizable firm, which I sold to the ING group. And that's how I ended up working for these big companies. I was the CEO of ING's advisor group, which was large at the time. It was 10,000 FAs. And then later, as you'd already mentioned, I was at AIG before it became Osaic and then Cetera. And along the way, to answer your question about the changes, and I'll try to be as brief as I can because it's a lot of years, the big trends that were beginning when I first got into the business remain. I would say the largest trend was the movement from the employee model to independent advisors. So when I first joined the industry, those of you who've been around for a while probably remember there were obviously a lot of the wirehouses were there, and there were more of them than there are today. But there are also something in the neighborhood of 30 regional firms that were oftentimes anywhere from 300 to 1,000 advisors. They might be in a half dozen cities. And those firms were at that stage, so we're going back 25, 30 years, were beginning to lose their advisors. And then also a very large group were firms that were losing advisors were the insurance companies who back in the 80s and 90s had really strong training programs. So they would try to identify young people with skills required to make it as advisors. train them. And what all these firms were finding, from the wirehouses to all the way down to the insurance companies, were the advisors had very limited products. So if you were a Merrill advisor, then you could sell Merrill life insurance or Merrill mutual funds, or you could sell Merrill asset management. And if that didn't suit you, then you could leave. And of course, that's all changed now. But for the early years of my career, there were very, very large number, much larger than today, number of advisors that were going independent. And many of them then were going into the independent broker dealer stage, where they had fee-based products, but mainly commission products. And of course, today the trend continues, but many, many more advisors are going from the big firms to the pure wealth firms, fiduciary with some sort of a sidecar capability for brokerage. So that's the major trend. I guess the other trend we all recognize, and even though I personally don't appreciate it much, is we're all getting older, and the average FA has gone from late 30s to mid 50s over that period of time, and the overall universe of advisors has stabilized. And you didn't mention it in the intro because I hadn't told you, the last couple of years I've been an outside consultant with Bain Consulting, and so we do a lot of research, and we're seeing the trends that I described are slowing a little bit. We're still seeing really good growth on the pure fee side. We're beginning to see growth on the hybrid side again, which had slowed, and Cerulli is showing an uptick now. But I think we're in a great business, and I think it'll stay strong for at least the rest of our careers. And there are a few more trends, but I'd like to talk about them later in our conversation. So I hope that wasn't too much info, but that's what I'm seeing, and I think many of us on this call are probably living.
Yeah, that's really interesting. So you think that movement from the insurance space and to the broker-dealer space was driven by, a desire to have a wider variety of products, or was it the commission versus fee-based?
Well, in the beginning, it was really product based, and because a lot of these advisors, and those of us who've been in the industry for a while know this, but becoming an advisor 25, 30 years ago was really, you'd have a draw or a small salary for a short period of time, and you'd go out there and have to find your own clients and bring them in, and it was really hard. And what the advisors were learning, the most successful advisors were learning that they were good at attracting clients and helping identify their needs, but when it came time to solving for their, finding solutions, they've had a really limited offering. And so they became frustrated and said, well, gosh, I'm able to attract these wonderful clients. Some of them are quite wealthy, and all I can offer them is pick the firm, the mutual fund family that we own, as an example. So they later, it did find its way, as you just mentioned, into more of a full service fee-based environment, which of course is where most assets are today. But early on, that's what that driver was. I need to better serve my clients, and I don't think I can do it at my firm.
And Larry, you mentioned just the pure number of advisors and the age demographic of advisors. What are your thoughts on the pure number of advisors over the next 5 to 10 years? Are we going to see a lot of retirements, but at the same time see a lot of younger folks come into the business? Or I know some people have predicted that we're just not going to have enough advisors to serve the needs of people here in the United States. What are your thoughts on those numbers?
Well, that's a really important question, Mark. And the trends, and there's, pardon me, quite a few statistics. I really seem to do the best job here, but the overall number of financial advisors was dropping, and it had been for a number of years. It's now stabilizing and perhaps growing just a little. But if you look kind of below the surface a little bit, many of the new advisors are coming into kind of a W-2 environment. So they might be, perhaps they're being hired by Schwab or Fidelity or Janus as a person to work inside, train them as a CFP, help them in a call center environment. Many of them are also kind of next-gen advisors working for the large fee shops. So to answer your question, I don't want to get too narrow here, but I think the absolute number of advisors will continue to decline, and the number of kind of clients per advisor will increase. But there seems to be a separation between the more traditional advisors who will still have a finite number of clients, but not too many. And then those that are working in the kind of in the call center environment who will have a very large number of clients. Some of the FAs in that environment are trying to service 500 people. And we all know you can't do a great job for 500 people. You're really just answering questions.
Yeah. Yeah. And I think investors have made choices. My parents used to always tell me you get what you pay for. And so, people not wanting to pay a lot, you're not going to get a lot, and you're going to be assigned to somebody who's trying to work with 500, 1,000 clients at one time, which is a daunting task. I remember the firms that you were with back, 25 years ago, when you were a client of Pershing for many years. And I remember, the independent model was kind of, and I don't think you ever put yourself out this way, but it just was the way it worked was, hey, we'll kind of be everything to everyone. And hey, you want this particular technology? Great. Well, we'll offer it and support it for you. But over time, I think we learned that really didn't scale well. And those firms were, running on fairly thin margins. And a lot of them, as you know, better than anyone, a lot of those firms have since gone. But you were really at the forefront of trying to figure out how to make these independent firms more scalable and how to do acquisitions and how to get into advisory. And, you led two of the three largest ones, Cetera and what we now know as Osaic. Share some thoughts just on, for firms, emerging firms that might be struggling with scalability, what are some of the lessons learned that you went through in your experience?
Well, I really appreciate the way you've kind of formed that question. Early on in the independent space, the idea of building a firm kind of organically was what everybody who really was an operator in terms of a general manager of a business aspired to. But there were very few firms who've done that. So as an example, the Commonwealth firm is, as we all familiar with, one of the leaders in this industry, the highest service levels in the industry, frankly, the highest kind of assets per advisor in the independent space, accomplished that. Over whatever number of years it's been, I haven't counted them, but I bet it's been 25 plus. That business has grown without doing acquisitions, focused very much on service levels, great technology. It's never perfect in our space because there's so many needs and different types of product sets, but they've done a great job. Other firms, just to use as an example, when I was at Advisor Group, we had like 1.7 or 8 brands, but we consolidated down to 4. And at that time, those were all acquired through separate acquisitions. But then we built a common back office for all the firms, and that worked pretty well, and that was scalable. But that became less efficient once the PE environment changed and people in the private equity space started buying up firms. And so I'm not sure, Mark, where you're going with this, but what I'm learning today is the firms that got super kind of aggressive in doing acquisitions, including my old firms, but others also, have found that they've kind of overwhelmed themselves. And I refer to it in meetings as they have, some cases, severe indigestion from buying all these businesses and trying to maintain service levels. So it's been very difficult. Some firms have pulled it off better than others. I mean, I think we know LPL's done a bunch of acquisitions, but then moved everyone onto the core. As I mentioned, Commonwealth chose not to. The Osaic firm is kind of a hybrid. They use the old core, and I can't take credit for it. It was 10 years plus years ago, but that was the core for now. They're moving other businesses on, but that's disruptive too, because you're causing your advisors to learn all new systems. And then Cetera, I think, has not yet really, to use an expression, bit the bullet and tried to integrate all that. So it's hard. And it's the advisors, thank goodness, the independent advisors who really are focused on the clients and care more than anyone about their clients, as you would expect they would, are kind of the buffer. So if there's a inefficiency in the back office at any of these firms, the advisors and their staff, I think, try to make up for it by kind of doing all the work behind the scenes. But it's not highly efficient. And Mark, you're an expert in technology and many other things, and I thought you'd have fixed it by now, but I haven't figured it out.
Well, it's not just the operational systems, right, they're trying to merge, and there's a huge learning curve to that. It's also a cultural switch for some of these broker-dealers, and it requires a top-down strategic overhaul, right, of the firm itself. Where do you see that coming in right now? Who's doing that successfully, Larry?
Well, your point is really the point, in my opinion, Cheryl, that it does need to come kind of from the top of these organizations.
Mm-hmm.
The challenge, in some cases, especially those that are private equity owned, is the investors, the private equity investors tend to have a time horizon that is shorter than the time it takes to kind of accomplish all that they would like to accomplish. And so what I would say is some firms who are public or remain private, some of the firms we've already talked about are leaning into it and doing really great work. Other firms are balancing the costs, the actual financial costs with the disruption to the advisors, because disruption at the advisor level can translate into attrition.
Mm-hmm.
I like to say, when the carousel goes around slowly, it's very enjoyable. When it starts spinning at 45 RPM, all kinds of things fall off. And so they're trying to find a balance. And I think that my personal opinion is they're all doing the best work they can, but their limiting factors tend to be the capital and the time horizon. And if you go too fast, you damage the business,
Mm-hmm.
reduces the value of the business, which, by the way, is the reason they bought it, is to obviously improve it and sell it. So I think one of the main reasons it's taking longer is really a function of the profile of the owners of the company. And no disrespect to them, they're all super smart, but they have a different kind of agenda.
Mm-hmm.
And then the other kind of point that I think you've experienced with businesses that you own and Mark sees all the time in his consulting practice is some of the best solutions are not in the house. So they'll find a firm like yours, just to use an example, and they will say, well, we need our clients to have access, or our advisors to have access to tools like Income Conductor, for example. And so we're going to approve you and support you and get you in front of it, but you're not integrated fully so that every advisor can just sort of hit the button and download all the data and serve their clients. So it's a little bit of a challenge, because they want to offer the best solutions, but they don't want to mandate the best solutions. And even if they wanted to mandate them, they really can't, because they're not fully integrated. So all these things slow down the kind of progression. But
Yeah.
we'll get there over time, but it is difficult.
Yeah, I'm a big fan of buy versus build. After having worked at very large companies, build it and they will come. You often can't achieve the creativity and the cutting edge solutions that smaller agile firms are out there offering. So I think the best world is, to partner with the technology firm and, really, as you say, integrate, Larry, versus just approve.
I think that is the solution. I agree completely. And I do wish some of the firms would invest more energy in, for lack of a better word, promoting their best-in-class partners, because they're busy, and you've been to many of these conferences. They spend millions of dollars, and people pay to participate, obviously, to help offset the costs. And smaller like, I'll say niche, although what you do isn't a niche, it's really everybody's retirement, but the kind of the specialists don't get the kind of the exposure that they really need and deserve, generally speaking, at the big firms. So it's tough, but it'll over time, I think it'll work out fine, but it's taking longer than I as an operator, it's taking longer than I would have hoped.
Yeah.
Hey, Cheryl, we have a question that came in. The timing might be good, and I think it might even lead into your some of your next questions. And the question from John is, what does the landscape look like a year or two down the road for advisor and fintech M&A? We read about the big deals, but there must be a lot of deals with less zeros in the price tags. And Larry, I know you're involved with a lot of those, or have been involved with a lot of those. So I think you're really qualified to talk on this one.
Well, so John, thank you for the question. In this, I'm to make sure, I hope I hitting on the kind of the more precise question you're asking, but there continues to be, and Cheryl will speak to this, I think, a little bit, a very high number of transactions. One of the major trends is, just going back over the years, just a few years ago, firms that were large RIAs and large broker dealers were being sold kind of as a platform.
Mm-hmm.
And there's very little of that going on now. And mainly because the whales have all been, not all, but many of the whales have been acquired, and they're looking to continue to grow, and organic growth is hard. And so they're continuing to look for inorganic growth, and they're acquiring more and more businesses that are smaller. So one of the trends is, if an advisor, you had to be a couple $1 billion of assets, call it 5 years ago, and now if you have 100 billion or million, excuse me, or 150 or 200 million, there are a lot of firms that would love to have you join the firm. Of course, if you do that, you're not likely to be the platform. You're likely to be a person who's saying, wow, I'll join you. Maybe I'll become a W-2 person for 4 or 5 years, take really good care of my clients, and then I'll retire here and I'll get paid in the process. So it's not a bad trend if you're a mid-size, high-quality advisor. It reminds me of the physicians joining the staff of the hospitals 15, 20 years ago, saying, I'm going to join a hospital. We're in New York here, hospital for special surgery. My clients, my patients to be well taken care of. They're going to write me a check for a few $1 million. And when I do retire, I'll have peace of mind that I had a great career. I monetized my business. My clients are happy. So I think we'll continue to see a lot of transactions. They'll tend to be smaller. You mentioned fintech in your question. Mark, you may want to opine on that. You're more of an expert than I am. Fintech's animal right now.
Well, it's probably a much longer conversation, but there's just so many more fintechs and wealth techs out there serving the industry. And, from an advisor's perspective, it's just, it's almost confusing to the point of, I'm just going to focus on what I know and what I use. And, the 600 others that are on the Michael Kitces tech map, like, I'm not going to spend a lot of time on that. I'm serving clients, and somebody else can research that stuff, but I'm not focused on it. So I know we talk a lot about, because we're in, tech circles, but I think most of the advisors, especially independent advisors, are not paying a lot of attention to it, and probably not as much attention as we think they're paying to it.
Yeah, I think they're certainly overwhelmed with the number of choices now. It's going back to the number of types of jellies on the grocery store shelf.
Exactly.
It's decision paralysis. So getting back to the M&A, I shared with you, Larry, that a recent stat was that there were almost 600 M&A deals just in Q3, representing announcements worth $38.7 billion. And this may be, consolidation of larger companies. Like you say, it may be a lot of smaller plays, but What do you see as the key considerations, challenges, and strategies behind all these mergers and acquisitions? I mean, what do you think is the most important that people need to keep their eye on?
Well, I would say the main driver remains essentially private equity funds, dry powder. I mean, the amount of dry powder in the private equity world is larger than it's ever been by a long shot. The other key driver is the consolidators, the big firms, and there are quite a few now that are 100 billion plus, are working hard to build their organic growth capabilities. But in the meantime, their advisors, some are aging, some are retiring, and it's really important for them to continue to grow inorganically. So it feels in some ways like the old broker-dealer world that I lived in, where you needed to retain 96-7% of your advisors, and you needed some market activity, and then you needed acquisitions. It's so the each of the big firms has a team. In some cases, it feels like a small army who are out there trying to find advisors who are willing to join. Big shops are great, but small teams are arguably better, because then you can move them right on and rebrand them. But I think that will continue. And we all know this, but just using round numbers, if the average advisor is approximately the same age as their average client, the clients will be clients maybe 25 years longer than the advisors will be advisors. And so the acquirers are looking at that and saying, well, I'm going to try to buy Larry's practice because I know he's going to retire in the next few years, but those clients will be mine for hopefully 20 more years. So there's a huge opportunity on the acquisition side to identify quality advisors of a certain age and bring them over now. And so they're really hitting the gas. And maybe 10 years from now, or even 5 years, it'll be a different ballgame, because a lot of the folks that are nearing retirement will have already kind of hung it up. But I think it's going to be like this, Cheryl, for at least the next few years.
Well, I imagine they're looking ahead to the generational transfer of wealth as well.
Oh, absolutely.
Yeah. So how do you think this will impact the industry? Are we going to see, different models arising from this?
I think the main impact at an industry level, it reminds me of using these examples, but a little bit of the banking industry. I think we'll have some number of really large, high quality, fee-based, probably fiduciary or near pure fiduciary firms. Fisher, Wegg, Mariner, you name it. Some of the big consolidators like Focus and Hightower will be in there, but they have more work to do, because they have multiple everything in terms of back offices. So I think we'll see a significant number. I don't know if that number is 12 or 20 major players in the country, and then we're going to continue to see smaller firms starting up, because we're already seeing a trend where people sold their business to one of the consolidators, and after 7 or 8 years, they're saying, I'm not having any fun anymore. This is, not what I had in mind.
Yeah.
Of course, the check's cleared, their handcuffs are off,
Yeah.
and they already went independent once, and they're setting up a new shop. And so I think we'll see, to use just sum it up a little bit, some number, 20-ish, whatever it is, of the really big branded firms, and then we're going to see other firms being born and prospering. But they'll be, when they do kind of spin out, I think they're going to have single service model, single pricing, very client focused. They'll have generational kind of transfer capabilities from day one, so they knew the young folks can buy out the kind of the retiring people. It won't be like it was the first time, when many of us joined the independent space thinking we were going to live forever and wondering, not thinking about the future. I think the new firms they're thinking about kind of a permanent wealth kind of a permanent capital structure that they can sell into, and the younger people can buy into later. So I think it's very sustainable in my view.
Hey, Larry, we had one other question that came in. Thanks again, John. Are there any warning signs for an individual advisor or group as they look around for a firm to join? What would be a red flag to stay away from, or conversely, what is a good sign to keep an eye out for?
Mhm.
Well, something to be aware of, and, and I'm sure you are already, but something to just keep in mind, I guess, to use your term, Mark, is the there are very few firms that are in kind of a steady state. So I will give you an example. The big RIAs that went public are all going private again. What a surprise! That is a surprise, right? The big private firms are not, because there's so much capital, are not immune from being bought again by somebody else. And I do believe there will be more, in a few cases, firms that are private equity owned that are going to go public. So what does that mean? It means to me that if you can't really do business on a handshake and expect folks, even if they're your age and you're going to work for 20 more years, to be at the helm for that period of time. I just don't see that happening. So, but if you're thinking about monetizing or selling your business, I would say and I assume you're independent. Take a lesson from what we've seen in the wirehouses, that the independent firms are doing all they can to move assets onto their platform, their custody, their fee-based platform, their tools. And they're doing this as we're all getting a little older every day. And part of the plan is the longer, and I'll use myself as an example, the longer Larry sticks around and the more of his assets are on my platform, frankly, the less valuable Larry's business is, because it's less portable and his clients are being well served. And so these firms are counting on, in most cases, having the opportunity to purchase the independent advisors' practices and make them either W-2 advisors, if that's what you choose to do, or either buy your business and feed it, so to speak, to a W-2 advisor where their margins are better and they own them permanently.
Mm-hmm.
If you look at it from a financial standpoint, they want their client, they'd like your client to be their client. And they're happy to have you as an independent because it's very profitable. But what they're really looking for is those clients after you retire. So those are not so much warning signs, but you keep your antenna up, because you want to maintain some level of portability in your business, unless you just plan to stay where you are, in which case that's fine too. But that's not where the big prize is financially.
Great point. Thank you.
Well, we've come to the end of our 30-minute webinar, Larry, and as always, our Trailblazer guests, we could spend hours more talking with them. Thank you so much for sharing your insights and your experience with our listeners. We really appreciate it.
Well, thank you. It's a pleasure and an honor. It's great to see you, Cheryl. Great to see you, Mark. And hopefully next time it'll be in person.
Awesome.
All
Thank you,
right.
Larry.
So long. Bye-bye.
Well, happy
Bye-bye.
holidays, everybody, and we'll see you in January at our next Trailblazers. Thanks.
Happy holidays. Bye-bye.
Bye.
Thanks, Cheryl. Bye-bye.